Welcome to the Deep Dive. We're here to unpack some really complex financial, sometimes historical questions, and really pull out the insights that matter for you. Today, we are tackling what feels like the Mount Everest of financial questions. It's huge, it's loaded, maybe even impossible. Who actually is the richest person who ever lived? And we're not just, doing a quick inflation check here. We're digging into what wealth even means.
Exactly. Forget the Forbes list for a second. I mean, Elon Musk, Jeff Bezos, sure, huge numbers. We hear about Musk maybe making, $100,000 a minute when Tesla stock is soaring. But how on earth do you compare that kind of, let's call it paper wealth, equity wealth, to someone like Mansa Musa back in the 14th century? We're talking literal tons of gold.
Right, or even Augustus Caesar, the guy basically owned Egypt. Is that wealth? Is it power? That's what we want to unpack.
Precisely. So our goal here, it isn't really to land on one name with a, frankly, made-up dollar figure next to it. That's kind of pointless. The real mission is to dissect the nature of wealth across time. Is it cash? Is it equity, like Rockefeller? Or is it just raw power, like maybe Stalin, controlling a whole state's resources?
And we want to understand how the ways wealth gets concentrated, whether it's through controlling 14th century trade routes or, navigating 2025 stock markets, how that concentration impacts financial stability. It's a big one.
It is. We'll be using historical accounts, economic data, everything we can get our hands on to piece this together across different eras.
Okay, so where do we start? Usually it's the headlines, right? A few years back, everyone was talking about Elon Musk surpassing Rockefeller's historical wealth. Musk's numbers are mind-boggling, obviously. But then you have Rockefeller, who at his peak supposedly controlled something like 2% of the entire U.S. GDP back then. That sounds comparable, maybe.
Well, it sounds like you could just take 2% of the U.S. GDP from, say, 1913 and inflate it to today's dollars. Easy, right?
Oh, I sense a butt coming.
A big butt? The moment you try to do that, to compare wealth across these huge time gaps in different places, the whole exercise starts to fall apart. It's fascinating to think about, but honestly, it's a fairly futile task, quantitatively speaking.
Okay, hold on. Why? We use inflation calculators all the time to compare, say, the price of a house from 50 years ago. Why doesn't that work when we go back 500 years or 2,000 years?
Two big problems. First is what you could call the dollar illusion, and it really comes down to the math. Calculating inflation over centuries involves exponential growth, and exponential calculations are incredibly sensitive to your starting assumptions. Let's say you assume inflation averaged 2% a year over 500 years versus, say, 3%. Seems like a tiny difference.
Maybe 1%. Doesn't sound like much over 1 year.
Over 500 years. It's enormous. Compounding a single dollar at 2% for 500 years might give you, $20,000 today. But at 3%, that same dollar becomes over $250,000. The problem is, economic historians just don't have reliable, continuous data for inflation rates or exchange rates going back that far. The data's patchy, incomplete, so any number you come up with is built on shaky assumptions. It's just too unstable.
Okay, so the numbers themselves are problematic. What's the second hurdle? You mentioned context earlier, the purchasing power problem.
Exactly. This is almost more fundamental. Even if we had perfect inflation data, what does a dollar or a denarius or a gold dinar actually buy in these different times and places? Think about it. What could Mansa Musa buy with his immense wealth in the 14th century? He could fund armies, build incredible mosques like in Timbuktu, control trade in salt and gold, maybe get the finest silks.
And today?
Today's billionaire can buy things Musa couldn't even conceive of. Instant global communication, advanced medical treatments that extend life significantly, maybe even a trip to space soon. They can buy access to technologies and experiences that simply didn't exist.
So the basket of goods is completely different. You can't compare.
Precisely. A top surgeon today can perform operations the richest person in 1850 couldn't dream of, let alone pay for. The quality, the very nature of goods and services changes so drastically that comparing purchasing power becomes, the economists call it, quantitatively meaningless.
It's like comparing owning the best horse-drawn carriage in 1800 to owning a private jet today. Different worlds.
Entirely different value systems, different technological contexts.
Okay, so direct comparison is out. But let's talk about the figures themselves because they are fascinating. The name that always comes up first is Mansa Musa, Emperor of Mali, 14th century.
Ah, Mansa Musa. His story's incredible because his wealth was so tangible. It wasn't stock options or complex derivatives, it was gold. And salt, which was hugely valuable then. His empire, Mali, was geographically blessed. It sat right on top of major gold deposits and controlled the key trans-Saharan trade routes. This wasn't just luck. It was strategic control over resources that Europe and the Middle East desperately wanted.
And the story everyone knows is his pilgrimage to Mecca, the Hajj, around 1324. This wasn't just a religious trip, was it? It sounds more like a massive display of power.
Oh, it was a statement. An unbelievable spectacle. Imagine a caravan of supposedly 60,000 people trucking across the Sahara.
60,000.
That's the traditional number, including, accounts say, 12,000 attendants or slaves, many dressed in Persian silk.
Yeah.
In the famous part, maybe 80 camels, each loaded with around 300 pounds of pure gold.
Just doing quick math, that's 24,000 pounds of gold on camels.
Exactly, just being transported across the desert. Can you imagine the logistics, the security?
And the impact when he arrived places like Cairo.
Game-changing. He was apparently incredibly generous, distributing huge amounts of gold as gifts and alms in cities like Cairo and Medina. He handed out so much gold, especially in Cairo, that he completely flooded the market. The value of gold plummeted. It caused rampant inflation that apparently took the local economy something like 10, maybe 12 years to recover from.
Wow. One person's spending crashes a major city's economy for a decade. That's different from a modern billionaire moving a stock price.
It's a totally different scale of direct economic impact. He wasn't just influencing the market. His actions were the market event. He fundamentally altered the value of the main currency.
And it wasn't just about the gold he gave away. He invested back home too, right?
Absolutely. He was a devout Muslim and used his wealth to massively promote education and culture. He financed the University of St. Khor in Timbuktu, making it one of the greatest centers of learning in the Islamic world at the time. He commissioned architects to build stunning mosques, like the Jingariber Mosque, using advanced techniques for mud brick construction. So his legacy wasn't just temporary inflation, it was lasting cultural and intellectual infrastructure.
So we have this figure whose wealth could destabilize foreign economies and build lasting institutions. But putting a number on him, that's where it gets fuzzy again, because was it his wealth or the state's?
That's the core issue with autocratic rulers like Musa, or Genghis Khan, or Augustus Caesar. The line between the ruler's personal wealth and the state treasury is, well, basically non-existent, or at least very blurry. Was the gold Musa gave away his personal piggy bank? Or was it Mali's strategic reserve that he just had absolute control over? The distinction probably wouldn't have made sense to him. He was the state, effectively.
And then you mentioned Augustus, first Roman emperor. People throw around figures like, what, $4.6 trillion in today's money? How do they even get that?
Again, it's highly speculative. But that figure usually comes from the idea that he personally owned or controlled vast resources. He directly controlled Egypt after defeating Antony and Cleopatra. Egypt was the breadbasket of Rome. Controlling its grain supply, its taxes, its trade routes gave him immense power and resources. It wasn't about having $4.6 trillion in a bank account. It was about the control. Control over land, resources, entire populations, and their economic output. That kind of absolute direct control over a massive, vital economic zone. That's a form of wealth modern billionaires simply don't have, no matter how many shares they own. Their power is mediated through markets and corporate structures. Augustus's was direct.
Okay, that distinction is really key, isn't it? Historical wealth often being about direct control of tangible resources or state power versus modern wealth being heavily tied to financial assets, equity, often leveraged.
Exactly. And this pivot is crucial because while today's super rich might lack Augustus's power to command legions, the way their wealth is structured, concentrated in financial assets, especially among the top 1%, creates entirely new kinds of systemic risks for the global financial system. Risks that echo across everything.
So we're shifting from history to the plumbing of modern finance. You mentioned different types of modern wealth.
Right. For understanding financial stability, we really need to distinguish between two main categories. You've got real assets and you've got financial assets. Real assets are things like housing, land, commercial real estate, tangible stuff. They're vital because they act as the main collateral for loans. Banks lend against property values, right? So real assets underpin credit creation.
And financial assets.
That's your savings, bonds, stocks, equity stakes in companies. These are more liquid, generally. They boost bank liquidity, fuel lending from a different angle, and they react much faster to market sentiment and news. Both types are crucial, and both are linked to how crises develop.
And the problem arises when these assets become heavily concentrated, leading to a feedback loop.
Precisely. What we've seen, especially over the last few decades, is that as wealth gets more concentrated, particularly in that top 1% bracket, it tends to fuel demand for riskier assets. The wealthiest households generally have a higher tolerance for risk, and a greater capacity to invest in things like stocks, venture capital, private equity. When they feel optimistic, they pour money into these assets, pushing prices up.
Which benefits them disproportionately, reinforcing the concentration.
Exactly. It creates this cycle. Rising concentration leads to higher demand for risk assets, which inflates asset prices, creating potential bubbles in housing or stocks. These bubbles are now widely recognized by economists as major channels through which financial crises emerge. A shock hits, the bubble bursts, and the system trembles.
This view really changes how we should think about predicting financial trouble, doesn't it? It suggests that just watching, say, credit growth isn't enough. Wealth concentration itself is a warning sign.
That's one of the most critical findings from recent economic research, including work I've been involved in. High wealth concentration isn't just a result of economic activity. It's a powerful, long-horizon predictor of financial fragility. It tells you trouble might be brewing years down the line.
Wait, long horizon? That seems odd. Markets move so fast. Why would an inequality measure take years to signal a crisis?
It's a structural process. Think about it. First, it takes time for that concentrated wealth to significantly inflate asset prices across the board. It's not instantaneous. Second, real estate cycles, which are tied to broader wealth accumulation, tend to move slower than stock market cycles. And third, there's often policy inertia. Regulators might be slow to recognize or react to the risks building up from wealth inequality until things get quite advanced.
So what kind of lag are we talking about?
Our research points to a couple of specific lags. When you look at the wealth share of the very top, the top 1%, an increase in their share seems to raise the risk of a systemic banking crisis about a couple of years later, usually 2 years. But when you look at the overall accumulation of private wealth relative to the economy, what we call the wealth-income ratio, or WI ratio, increases there. Take longer to manifest as risk, typically 3 or 4 years before they significantly raise the odds of a major banking crisis.
These are slow-burning fuses.
Okay, let's make sure we understand the WI ratio, private wealth to income. What exactly is that measuring?
Simple concept, really powerful indicator. It's the total stock of net household wealth in a country, all the houses, financial assets, minus debts, divided by the country's annual national income. Basically, it's GDP. When that WI ratio shoots up rapidly, it means wealth, often driven by rising asset prices like houses or stocks, is growing much, much faster than the underlying economy's ability to produce goods and services, income. It suggests the economy is becoming heavily reliant on asset appreciation, on capital gains, rather than productive activity. That's a classic bubble warning sign.
And we've seen this pattern historically, this lag before a crash.
Absolutely. The data supports it clearly. Think about the lead up to the Great Crash of 1929 and the subsequent banking crisis. In the years before 1929, the wealth share of the top 1% in the U.S. had climbed significantly by about 10 percentage points. In France, it also rose, maybe 5 percentage points. These inequality metrics were flashing red, signaling rising structural fragility for years before the actual crash hit. The warnings were there in the distribution data.
Wow. So this concentrated wealth fuels bubbles in two main areas, housing and stocks. How does that work differently for each?
There's a strong link to both, but the specific driver seems slightly different.
Okay, so if I'm worried about a housing bubble, what metric is most important?
For house price bubbles, the strongest predictor seems to be the growth in that overall private wealth to income ratio, WY. This makes sense because for most people, not just the super rich, housing is the single biggest component of their wealth. So when house prices boom, fueled by easier credit or speculation, that pushes up the overall WY ratio quite dramatically through capital gains on property. Across many countries, a rapidly rising WY is a big red flag for housing market instability.
Got it. WY for housing. And what about the stock market, where the Musks and Rockefellers historically held more of their fortunes?
For equity price bubbles, the data consistently points to the growth in the top 1% wealth share as the more significant driver. Again, this aligns perfectly with what we know about portfolios. The wealthiest 1% hold a much larger fraction of their assets in financial instruments, stocks, bonds, private equity, hedge funds, that kind of thing.
So when we talk about Musk's witchcraft tech stock performance driving his network into the stratosphere,
what you're really seeing is that structural feedback loop in action. Highly concentrated wealth at the top fuels demand for these growth-oriented, often tech-heavy risk assets. This inflates equity valuations, potentially creating bubbles, and simultaneously signals that systemic risk is building up over that 2 to 3 year horizon we talked about. It's a modern manifestation of wealth concentration driving instability.
Okay, so we've got this underlying structural risk from wealth concentration brewing over years. Now let's bring it right up to today, to 2025. The immediate picture looks what? Complicated. We've got wars, high interest rates sticking around, global trade patterns shifting. Uncertainty seems like the only certainty.
Absolutely. For anyone managing significant wealth or even just trying to understand the economic landscape, navigating 2025 requires looking beyond just market fluctuations. There are major geopolitical and macroeconomic shifts underway. We see about 4 key trends converging right now that sophisticated investors, especially ultra-high net worth individuals, really need to factor into their strategy.
Let's break them down. First up, you mentioned one that sounds huge, de-dollarization. Is the dollar really losing its grip?
It's definitely being challenged. This isn't necessarily about the dollar collapsing tomorrow, but its dominance is facing real headwinds. A big driver is how the U.S. has increasingly used access to the dollar and the U.S. financial system as a tool for foreign policy, sanctions, tariffs, things like that. That's pushed major players, especially countries like Russia and China, but others too, to actively look for ways to trade and hold reserves in other currencies to reduce their vulnerability to U.S. policy.
So countries are trying to build alternatives.
Yes, and coalitions are forming. Look at the BRICS group. Brazil, Russia, India, China, South Africa, now expanded. They're explicitly talking about creating alternative payment systems and pushing for more trade in local currencies. Institutions like the New Development Bank, the BRICS Bank, are trying to facilitate this by lending in local currencies, bypassing the dollar, and maybe even institutions like the World Bank or IMF, where the U.S. holds significant influence.
And what does this mean for investors?
It means you need to be much more aware of currency risk. Investors are already starting to diversify away from holding everything in USD. They might look more towards assets in Europe or other stable non-USD markets, worried about potential dollar depreciation or just policy risk from the US. It demands active currency management in portfolios.
Okay, trend 2. Geopolitical instability. Sadly, that feels like a constant now.
It does. The war in Ukraine continues. There's immense tension and conflict in the Middle East. And U.S.-China relations remain very strained. This isn't just political noise. It has direct economic consequences. We're seeing major disruptions to global supply chains. Key shipping routes, like through the Red Sea and Suez Canal, have become dangerous or much more expensive to use due to attacks and higher insurance costs.
Which means delays and higher prices for goods.
Exactly. It drives up costs for energy, for industrial commodities, for finished goods. It creates uncertainty for businesses relying on complex, just-in-time global supply chains. For investors in UHNWIs, it means potentially favoring more resilient, maybe localized investments and being very careful about deploying capital into regions directly affected by instability or vulnerable supply lines. Efficiency might take a backseat to resilience.
Third trend, those elevated interest rates. They were supposed to be temporary, weren't they?
Well, inflation has been stickier than many hoped. So central banks in the US, Europe, and elsewhere are keeping rates relatively high compared to the ultra-low levels we got used to over the last decade or so. This has a direct impact. If you use leverage borrowing money to invest to, your financing costs are much higher now. That makes big leverage plays like buying international real estate or acquiring businesses more expensive and potentially less attractive.
And it hits asset values, too.
Definitely. Higher interest rates generally mean lower valuations for risk assets, especially those promising growth far in the future, like tech stocks, venture capital, private equity. The discount rate used to value future earnings is higher, so present value is lower. The basic cost of capital is up, and that changes the math on a lot of investment strategies.
Okay, and the fourth trend you mentioned was ESG scrutiny. Sustainable investing isn't going away, but it's changing.
Exactly. The demand for investments that consider environmental, social, and governance factors is still strong. But there's been a growing backlash against greenwashing.
Meaning companies just saying they're green or socially responsible without really doing much.
Precisely. Investors and regulators are getting much tougher. They want proof. We're seeing stricter disclosure rules coming into effect in places like the EU, the US, Singapore. Companies have to provide real data, measurable outcomes to back up their ESG claims. This creates regulatory risk. If you make claims you can't substantiate, you could face penalties or lawsuits. It's why you saw some big U.S. banks pulling back from initiatives like the UN's Net Zero Banking Alliance. They were facing political heat at home and potential legal risks if they couldn't meet ambitious, maybe vaguely defined targets. The focus is shifting from just making pledges to demonstrating real, measurable impact and accountability.
Okay, we've covered a lot of ground. History, structural risks from inequality, the immediate headwinds of 2025. Let's try to boil this down. What are the actionable lessons here for someone trying to build or preserve wealth long-term in this environment?
I think we can pull out 3 core strategic lessons that tie all this together. Lesson 1 is about diversification, but taking it to a much deeper level.
We always hear diversify. What does deeper mean in this context, facing things like de-dollarization and geopolitical risk?
It means you can't just think about diversifying across stocks and bonds anymore. True diversification now has to be holistic. You need to spread investments across asset classes. Yes, equities, bonds, real estate, alternatives like private equity or commodities. But crucially, you also need to diversify geographically across different sectors of the economy and, importantly, across different currencies.
How do you actually manage that complexity, especially cross-border?
This is where sophisticated global structuring becomes essential. For UHNWIs, it often means setting up things like international trusts, holding companies, or dedicated family offices. These aren't just for tax optimization anymore. They're crucial for asset protection and regulatory resilience. You see financial centers actively competing to offer these services. Think about Singapore, with its Section 13(0) and 13(u) schemes offering tax breaks for family offices managing assets there. Or Dubai's DIFC offering specialized foundation structures for wealth preservation. These structures help you navigate different legal systems, protect assets from potential claims or political instability in one jurisdiction, and actively manage that currency exposure we talked about, hedging against shifts driven by de-dollarization.
Okay, so lesson 1. Diversify deeply assets, geography, currency, using smart structures. What's lesson 2?
Lesson 2 comes directly from our discussion about wealth concentration predicting crises with a lag. If we know that rising inequality and wealth accumulation take 3 or 4 years to really heighten systemic risk,
Then you need to prepare well in advance. You can't wait for the crisis to hit.
exactly. The strategy has to be about proactive hedging and downside protection, not just reacting when markets tumble. That long lead time is actually an advantage if you use it. It means UHNWIs need to conduct really thorough, ongoing risk assessments. Not just market volatility, but geopolitical risks, potential liquidity squeezes in their specific assets, even black swan events like cyber attacks or major lawsuits. You need to stress test your portfolio against these long horizon risks signaled by inequality metrics.
And how do you translate that into action, beyond just knowing the risks?
You need concrete tools. This means using customized financial solutions. Things like getting the right insurance coverage for specific risks. Strategically using derivatives options, futures not to speculate, but to specifically protect against potential market downturns. Crucially, it also involves rigorous cash flow planning. You need to ensure you have enough liquidity accessible cash or near cash assets to ride out periods of market stress without being forced to sell assets at fire sale prices. And, importantly, given the risks we identified with concentrated financial wealth potentially fueling bubbles, your portfolio needs a solid allocation to tangible assets. Real estate, yes, but also maybe commodities, precious metals. These tend to behave differently from financial assets during crises and can provide a valuable hedge against both inflation and market dislocations.
Okay, diversify deeply, hedge proactively. What's the third lesson?
Lesson 3 is about how you approach growth. It's about leveraging the critical growth areas, but doing it with a new emphasis on accountability. The core idea hasn't changed from Rockefeller's time, really.
Meaning, find where the growth is.
Find where optimistic expectations are driving asset price growth. Rockefeller saw it in oil, the transformative technology of his era. Today's titans often see it in tech, AI, biotech, areas driven by innovation, what you called Musk's witchcraft tech earlier. These are the risk assets where concentrated wealth often flows, seeking high returns. The principle is the same. Identify and invest strategically in the sectors and technologies shaping the future economy, where that potential for significant capital appreciation lies.
But you mentioned accountability. How does that fit in, especially with the ESG scrutiny we discussed?
Right. Well, you're looking for those growth areas, particularly in fields like sustainable infrastructure or climate tech, which have huge long-term potential. You can't just invest based on hype or promises anymore, especially not with ESG. Investors need to demand rigor. Evaluate potential investments using clear, measurable metrics. Don't accept vague ESG statements. Look for things like verified reductions in carbon intensity, independent audits of labor practices in the supply chain, tangible evidence of positive community impact. Focusing on measurable ESG outcomes does 2 things. It helps you avoid greenwashing risk and ensures you're aligned with tightening global regulations. And arguably, focusing on genuine, measurable sustainability is also just good long-term business strategy. It offers real value beyond just feeling good. Hashtag Ultra One Take.
Wow. Okay, what a journey. We started trying to name the single richest person ever, realized that's kind of a fool's errand because the very meaning of wealth changes so drastically, and we landed on this idea that wealth, historically and today, is maybe less about a specific dollar amount and more about relative power, about control over resources, whether that's Mansa Musa controlling West African gold routes or the top 1% today influencing global markets through concentrated equity holdings and driving those asset bubbles we talked about.
I think that's the core insight. And the crucial takeaway for today, looking forward, is that wealth concentration isn't just a side effect of economic success. The data strongly suggests it's a powerful, long-range predictor of financial instability. It signals potential crises years in advance, which means managing wealth, and indeed managing the economy, requires a proactive, multi-year strategic view that explicitly accounts for these distributional dynamics. It's not about reacting to yesterday's news. It's about anticipating risks building over the next 3 to 4 years.
So that leaves us with a pretty challenging final thought for everyone listening. If we have mounting evidence that the long-term growth of private wealth, and especially its concentration in the hands of the very few measured by things like the wealth-to-income ratio or the top 1% share, is a reliable early warning signal for systemic financial crises, what responsibility do policymakers and regulators have to actually start incorporating these inequality metrics directly into their financial stability models now, instead of just focusing on traditional indicators like credit growth and maybe waiting until the bubble is already about to pop 3 or 4 years down the line? That's the big structural question to think about as you navigate whatever 2025 throws at us.